Let's go ahead then and take the conversation forward. Our first guest on the show today is Prateek Parekh, equity strategist at Nuvama Group. Prateek, happy Friday to you. Thank you for joining in. So that was a Jeffrey's view that we were just going over. But you tell us, the market has been looking at this positive consolidation. We've managed to kind of grind up to 19,800. At the end of the second quarter earnings season, what is the takeaway from here? I mean, do we have the earnings fuel, the valuation comfort to see a more meaningful move above 20,000 this time?
Yeah. Hi, Surabhi. Thanks for having me over. It's always a pleasure. I think if you look at this quarter earnings season, right, in my view, the key highlight is the trend on margins. This quarter, your BSE 500 profit growth has been 25%, which is very good. But the top line growth has just been 5%. The large gap has been bridged by improvement in margins. Margins at an aggregate level are at 13%, which is 400 bips higher compared to what they were pre-COVID and almost at a 10-year high. Such strong margins despite demand being weak, is a very rare phenomena. In my view, there are two key factors for the same. One is lower oil prices, which has boosted lower input cost and improved gross margins for manufacturing companies. And second is, for banks, while net interest margins have compressed because of deposits being repriced higher, the overall profit margins have still held up. This is largely owing to credit cost running much below trend of sorts per se. Now, both these factors, if you look at it, they are not very sustainable. The trend that you have in oil prices on a YOY basis, the benefits are no longer going to be there. Now, oil on a YOY basis is not very high, but which was down, for last couple of quarters, is now going to be 0% going ahead, assuming oil remains where it is. So your tailwinds on that front are going to fade. And also with regards to credit cost, today they are running very much below trend. And with RBI also, clamping down on the loan growth and with net interest margins, being where they are, clearly in our view, the earnings momentum, which has been very strong in H1 FY24, has most likely peaked out. In H2, we think it should slow down earnings, and to some extent, consensus pricing that in as well. For H2, Street is forecasting just 8%, EPS growth versus 25% what you had in first half. The challenge lies, I think, for FY25, where growth expectations are still running high and people are still betting on margin expansion to continue, which we think could be at a risk. And to that extent, there could be some disappointments there. But overall, the earning momentum that we've seen so far, it is driven more by transitory factors rather than sustainable ones. And from here on, demand will be very critical for, determining profit growth trajectory per se.
Got that. So Q2 profit growth is unsustainable according to you, and there is a risk to FY25 EPS estimate assumptions of 15%. So what could we actually end FY25 with in terms of an EPS growth?
Yeah, so I think it's very difficult to pin a number, but I think given where the demand environment is, given the global growth outlook, and given that RBI is wanting banks to slow down their loan growth, somewhere in single digits is where I would say, one should look at the EPS growth to end. Now, obviously, there are many moving variables here. If crude falls by another $20 because of supply improvement, there can be 50-60% growth can be met. If global growth hits a very soft patch, then I think there can be even more bigger downside. And if global growth surprises, then perhaps there can be some upside. But I think as a base case, single-digit growth for FY25, I think should be a more reasonable outcome that one should be looking for per se, Reema.
Okay. So let's talk a little more about the themes as well, because at least as far as, second half of this year is concerned, you're saying we're unlikely to see any down move because of earnings disappointment. Then which are the sort of the best sectors that could provide those surprise upsides, if at all, for the second half?
Yeah, so I think for second half, the way we are looking at sectors per se is that if you look at last year and more in general last 3-4 years, the biggest underperformance has ironically been in quality stocks. I mean, the term that was used pre-COVID, Ritik, which had HDFC Bank, Reliance, Infosys, TCS, the quality names, those have actually seen very large underperformance. And one of the biggest reason in my view is that you've had a much broader earnings recovery, and the valuations are much cheaper elsewhere. But today, we have come full circle over here. In my view, quality stocks or cash cows offer a lot more value. There, the earnings expectations are also more moderate, and to that extent, I feel this is a space which could potentially see an upside. So one theme that we're running with is, that quality now offers value versus being it the other way around over the past decade. The second thing is that with a lot of sectors, at or very close to decadal high or peak margins, we would rather bet on sectors where margins are at least at the close to bottom. For example, something like IT, where while demand outlook is certainly uncertain, I mean, there's no two ways about it. But where we do have a lot of comfort is on the margins part, where we think at least the margins have bottomed out. And with growth expectations being very moderate, any reversal on the demand front will actually can potentially lead to upside surprises in IT of sorts versus should be. So these are the two main themes that we are running with. Apart from that, we have some other micro themes as well. Something like cement is what we like, where we think, with pricing, cement in India is actually more of a consumer rather than commodity. And with prices now sustaining, this is again a sector which could potentially see more earnings upgrade versus should be.
Cement could see earnings upgrade. What about chemicals? Chemical companies have gone through a deep correction in the last 2 quarters, big downgrades on EPS estimates. But now the opinion is divided whether H2 is going to mark a bottom and things will start improving. Where do you stand on the chemical companies? And is there any particular, agrochemical companies, specialty chemicals, pharmas? Which ones do you like?
Yeah. So I think chemical companies clearly have had a very tough time, the last 1 year. For the time where you had global headwinds in terms of demand and prices, but also at the same time they're doing capex. So it was a double whammy of sorts for them. For chemical companies, I think clearly profits should bottom out, but I think they will remain at a much lower level for some time. And the simple reason is that chemical companies eventually are exposed to the global demand because the prices are determined globally. And to that extent, if global demand remains weak, which is our base case, then it's very difficult to portray a bull case scenario for chemicals. So while earnings have certainly bottomed out, we think the upside of chemicals may still be some time away. Within the chemical pack, I think the least defensive one, like agrochemicals, is what we think where the margin of safety lies higher, lies the most. And also, apart from that, companies which have strong balance sheets and which have good track record is what we would bet on. But nonetheless, for chemicals, while things may bottom out, the upside is still, is quite some time away. And stock valuations are not necessarily very cheap over there per se.
Okay, Prateek, we just have the last 1 minute on the chat remaining now. Very quickly, how does the report card look for the boys who were running the fastest? And here I'm talking about EMS, defense, railways, because, these are sectors, at least particularly, industrials, railways, defense, etc., where, earnings can be lumpy, orders come in and then stocks run up. How is the final report card looking at the end of Q2?
Yeah. So I think over here, in some sectors, it's still very strong. So for example, railways, there, I think the momentum is still very strong. Their orders are coming through, margins are great, and, it is genuinely capacity constrained sector of sorts. This is like the ideal and the sweetest spot that one can hope for. While stocks have certainly gone up, but nonetheless, I think the fundamentally, they are on the right side of things. And momentum perhaps should likely to continue further over there. With regards to electronics, I think it's a mixed bag where you are getting good demand and top line to that extent remains strong, but margins remain a concern area. I mean, margins are not something that have been very good and have actually disappointed, and valuations are somewhat stretched over there. So that is a space where one can perhaps be a bit more cautious. And finally, with regards to defense, as you rightly said, the orders can be very lumpy. And to that extent, there can be a lot more volatility. So maybe perhaps, with some moderation in stock prices, a lot more stocks can get attractive. But in of the three, clearly railways stands out, ticking all the boxes and almost like a purple patch for them. Perhaps followed by defense, and electronics is where, we think the margin concerns are something worth keeping in mind per se, should be.
Okay, got that. Yes, good to keep that in mind. Good to note. Thank you very much for joining in with a very comprehensive breakdown of where we stand at the end of the second quarter. Good speaking with you. You have a good weekend, and we will catch up again soon. Break on that note, but we're back with commodities, and we'll find out what's buzzing with Manisha Gupta in just a bit.